All right, everybody, welcome back to the Deep Dive.
Yeah.
We know your time is precious, and
Yeah.
it's tough to keep up with all the financial news coming out every single day.
It really is.
But don't sweat it, because we're here to break it all down.
Absolutely.
Today, we're going to take a deep dive into a really interesting article from The Motley Fool.
Very timely.
It was published on March 26, 2025, and it's called, "Here's How Many Interest Rate Cuts the Fed is Projecting in 2025 and What It Means for Stocks."
Big implications there.
Yeah, so this article goes deep into the Fed's latest projections for interest rate cuts later this year in 2025.
Right.
And how those cuts could impact the stock market and, by extension, all of our wallets.
Exactly. And it breaks down some really important information from the Fed's summary of economic projections, that SEP, as they call it. Forecast for things like economic growth, inflation, unemployment, interest rates, and then what all of that means for stocks.
Right. And so today we're going to dig into all of this and try to help you understand the key takeaways from the Fed's outlook and what it might mean for your investments and, the broader economy.
Sounds good to me.
All without, getting lost in all that confusing financial jargon.
We'll try to keep it as straightforward as possible.
So let's jump right in.
Okay.
So the Motley Fool article starts by reminding us about the Federal Reserve's dual mandate.
Dual mandate.
For those who might need a little refresher,
Yeah, sure.
what exactly does that entail?
So the Fed's dual mandate, well, it essentially means that the Fed has two really core responsibilities.
Yeah.
First, they're tasked with keeping inflation under control, trying to maintain price stability. And they've kind of set an informal target for themselves of around 2% inflation per year. They primarily use something called the Consumer Price Index, or CPI, to measure inflation. It gives us a sense of how much prices are rising for a basket of goods and services that, are commonly consumed by households. Yeah. And the Fed's second core responsibility under this dual mandate is to promote maximum sustainable employment. Now, this doesn't mean they have like a specific target unemployment rate in mind.
Right.
Like they're shooting for exactly 4% or anything like that. But they are trying to foster conditions in the economy that lead to as many jobs as possible without, causing other problems like runaway inflation.
Right.
And so to influence these two areas, inflation and employment, the Fed has a bunch of different tools at its disposal. One of the most important ones is what's called the federal funds rate. Now, this is the interest rate that banks charge each other for lending reserves overnight. Yeah. And by adjusting this rate, the Fed can influence borrowing costs through the entire economy. So, when the Fed wants to slow down the economy, maybe because inflation's getting too high, they'll raise the federal funds rate, making it more expensive for businesses and consumers to borrow money. And that can kind of cool things down. But on the flip side, when the Fed wants to stimulate the economy, maybe because growth is sluggish, they can lower the federal funds rate, making it cheaper to borrow, and that can encourage spending and investment.
Right. And I remember, we definitely saw the Fed use that interest rate tool pretty aggressively just a couple of years ago, right?
Oh, yeah, definitely.
Like when inflation was really spiking back in 2022.
You're talking about when the CPI jumped up to around 8%, right?
Exactly.
Yeah, well, that was a prime example of the Fed taking action to try to get inflation under control.
Right.
They started raising the federal funds rate like crazy to try to cool down the economy and bring those price increases back down to a more manageable level.
Gotcha. So with that kind of background on the Fed's dual mandate and their interest rate moves in mind, what are the Fed's latest projections looking like? This Motley Fool article talks about kind of like a mixed bag of bad news and good news in their recent report from March.
Yeah, that's a good way to put it.
Let's start with the bad news for 2025.
Sure.
What are they seeing on that front?
Well, compared to their previous forecast back in December, the Fed's latest summary of economic projections, for March, it's showing that they're not quite as optimistic about U.S. economic growth in 2025. They've actually narrowed their projected range for GDP growth down to between 1.6% and 1.9%. And that's lower than the 2% to 2.3% range they were anticipating in December.
Oh, so they're anticipating slower growth now.
Yeah, that seems to be the case.
Okay, so slower growth is one piece of bad news.
Right.
What else are they seeing that's making them kind of,
Less cheerful.
yeah, less cheerful about the economic picture?
Well, unfortunately, they also had to revise their inflation outlook upward for 2025.
Yeah.
They're looking at this measure called the Personal Consumption Expenditures Index, PCE for short. And their latest projection for PCE inflation is now in the range of 2.7% to 2.8%. And that's a bit higher than their previous forecast of 2.5% to 2.6%. So they're essentially saying that they think inflation is going to be a bit stickier than they initially thought.
So inflation's not coming down as quickly as they hoped?
Yeah, pretty much.
And is there anything else in this bad news category, or is that pretty much it?
Well, there is one more thing. They're also now anticipating that the unemployment rate will likely be a bit higher in 2025 than they previously thought. They're now projecting it to land somewhere between 4.4% and 4.5%.
Okay, so just to be super clear for everyone listening,
Yeah.
we've got weaker economic growth, we've got higher inflation, and we've got a potential rise in unemployment.
Right.
And that's generally not the kind of economic trifecta anyone's hoping for.
Yeah, that's a very fair assessment. That combination of factors
Yeah.
definitely suggests a more challenging economic environment ahead.
Okay, so that's the bad news side of the equation.
Right.
But we did mention that there was also some good news in this recent Fed report.
Oh, yeah, there was some good news tucked in there.
What was the more positive aspect of their projections?
Well, the good news is that the Federal Open Market Committee, that's the FOMC, it's the part of the Fed that actually makes decisions about interest rates and stuff. They're anticipating that the federal funds rate will probably end 2025 somewhere between 3.88% and 4.12%.
Okay.
Now, considering that the current federal funds rate is 4.37%, that range implies that we could see up to 2 interest rate cuts from the Fed this year.
Oh, so they're signaling that they might start lowering rates soon.
Yeah, exactly.
Interesting. And the article even mentions that, like, the overall market, Wall Street and all that,
Right.
they might actually be expecting even more significant rate cuts than what the Fed is projecting, right?
Yeah, that's right. There's this tool called the CME Group's FedWatch tool. And it's kind of like a gauge of what market participants are expecting in terms of Fed policy. And right now, that tool is indicating a possibility of 3 interest rate cuts this year. So, the market seems to be a little more optimistic about rate cuts than the Fed's official projections.
So there's kind of a discrepancy there.
Yeah, a little bit.
Interesting. So let's dive into what these potential interest rate cuts could actually mean for, people's investments in the stock market.
Let's get into that.
So the Motley Fool article points out that, historically lower interest rates can be good for stocks over the long term.
That's generally true.
But it also brings up the possibility of some, bumps along the way in the short term.
Right. It's not always smooth sailing.
So walk us through that a little bit.
Sure. So when we think about the impact of interest rate cuts on the stock market, it's important to keep in mind this sort of dual nature. There can be both positive and negative effects. So if we look at the longer term, over a period of years, lower interest rates can actually be quite beneficial for the stock market.
Mm-hmm.
And there are a couple of reasons for this. First, when interest rates on safer investments like bonds go down, stocks start to look relatively more attractive to investors who are seeking higher returns. So, you might have some investors who were previously content with the lower but more predictable returns from bonds. But when those bond yields drop, they might start looking to the stock market as a place to potentially earn more.
Right. So it's kind of like a shift in where people are putting their money.
Exactly.
When those safe havens aren't paying as much, people might be more willing to take on a little more risk in the stock market.
Exactly. And then the second reason why lower interest rates can be good for stocks is that it can make it cheaper for companies to borrow money.
Yeah.
Lower borrowing costs can really help businesses finance their operations, expand into new markets, and just invest in their growth.
Mm.
And when businesses are able to grow and become more profitable, that tends to boost their earnings.
Yeah.
And higher earnings generally lead to higher stock prices.
Okay. So that all makes sense. Cheaper money can kind of fuel more economic activity and potentially boost stock prices.
Right.
But then the Motley Fool article throws in this really interesting observation about past rate cutting cycles and their relationship with the S&P 500.
Yeah, this is where things get a little more nuanced.
Yeah, and maybe a little bit concerning.
For sure.
So they highlight this trend that since the year 2000, the beginning of every cycle where the Fed started cutting interest rates has coincided with a correction in the S&P 500.
Meaning a drop of 10% or more.
Exactly.
Yeah, that's a pretty striking pattern.
It is. I mean, every single rate cutting cycle since 2000 has seen a correction.
Yep.
I mean, that might make some people listening a little nervous.
Understandably.
So does that mean that the act of cutting interest rates actually causes these big market downturns?
Well, that's a really important question, and the article does address that directly. They clarify that these corrections in the S&P 500 weren't necessarily triggered by the rate cuts themselves. If we look at the specific examples they mentioned, like the dot-com bubble bursting in 2000, the global financial crisis in 2008, and the pandemic in 2020, Well, in each of those cases, the S&P 500 was already declining before the Fed started cutting rates. There were these big underlying economic shocks happening, and those were the primary drivers of the market decline. So the Fed was actually cutting rates in response to these emerging problems, trying to mitigate the economic damage. So yeah, while the rate cuts happened around the same time as those market drops, they were more of a reaction to the same underlying issues rather than being the cause of the drops themselves.
Okay, so that's a really important distinction.
Definitely.
It's not like the Fed cuts rates and then boom, the market tanks.
No, not exactly.
It's more like the market's already tanking for other reasons, and the Fed's like, okay, we need to cut rates to try to soften the blow.
Yeah, that's a better way to think about it.
Okay, so if those major crises weren't directly caused by the rate cuts,
Right.
why does the Motley Fool article still kind of suggest that rate cuts can be like a warning signal for the stock market?
Well, it comes down to why the Fed might decide to start cutting rates in the first place. Outside of those really big crisis situations, typically the Fed lowers rates when they're seeing signs that the economy is weakening. And, when the economy slows down, companies might start experiencing lower sales and lower earnings. And when that happens, investors often react by reducing their valuations of those companies, which, ultimately leads to lower stock prices.
Makes sense.
So in a more normal economic environment, not a full-blown crisis, rate cuts can sometimes be a signal that things aren't going as well as they could be.
Mm-hmm.
And that can definitely have a negative impact on the stock market.
Okay, so it's not that the rate cuts themselves are bad. It's more like they're often a response to something else that is bad.
Exactly.
And that something else could be bad for the stock market.
Yeah, that's a good way to sum it up.
Gotcha. So we're seeing the Fed project slower growth for next year, and they're anticipating cutting rates. Are there any other economic indicators out there right now that this Motley Fool article points to that are like potential warning signs of an economic slowdown?
There are a couple of key indicators that they highlight. First, the unemployment rate. While it's still relatively low at around 4.1%, it's been creeping up over the past year or so. And as we mentioned, the Fed is actually projecting that it'll continue to rise to around 4.5% in 2025. Now, a weakening job market can be a pretty strong signal that the economy is losing steam. When people are worried about losing their jobs or they're having trouble finding new ones, they tend to cut back on their spending. And that lower consumer spending can then ripple through the economy and impact corporate earnings.
Makes sense. If people aren't feeling confident with their job security, they're not going to be running out and buying a bunch of new stuff.
Yeah, exactly.
Okay, so that's one warning sign.
Right.
What's the other one the article mentions?
The other potential red flag is the University of Michigan's U.S. Consumer Sentiment Index. Now, this index basically measures how optimistic or pessimistic consumers are feeling about the economy. And in March, it dropped to 57.9. which is the lowest level it's been at since November of 2022. And it's interesting because November 2022 is actually right in the middle of a bear market for the S&P 500. So this declining consumer confidence is definitely something to keep an eye on. It can be a pretty good indicator of how much people are willing to spend in the coming months. Yeah. And, consumer spending is a huge driver of the overall economy.
Right. So if people are feeling less confident about the economy, they might hold back on making big purchases.
Exactly.
Which could then slow down growth.
Yep.
Okay, so we've got rising concerns about the job market, declining consumer confidence, and it sounds like some big names in the financial world are also starting to adjust their expectations based on this outlook.
That's right.
The article specifically mentioned Goldman Sachs and their revised economic projections.
Yeah, they recently came out and lowered their forecast for U.S. GDP growth in 2025. They're now projecting growth of just 1.7%, which is a pretty significant reduction from their previous estimate of 2.2%.
Wow. So they're getting a lot less optimistic about growth.
Yeah, seems that way.
And is that projection of 1.7% in line with what the Fed's saying, or is it even lower?
Well, it's interesting because their new projection actually aligns pretty closely with the lower end of the Fed's own forecast range. So they're basically saying that they think the Fed's probably right to be a bit more cautious about growth going forward.
Okay. And what are they saying is kind of behind this more pessimistic outlook?
Well, the Motley Fool article points out that Goldman Sachs is specifically mentioning concerns about potential future trade policies. They're talking about things like the possibility of new tariffs being imposed and the risk of other countries retaliating with their own tariffs.
Oh, so like a potential trade war?
Yeah, basically. And they're saying that all this trade uncertainty could end up reducing consumer spending and, potentially even sparking a broader global trade war, which would obviously be really bad for the global economy.
Right. So they're drawing a pretty direct line between trade policy and economic growth.
Yeah.
And it sounds like this less optimistic view on growth is also influencing how they see the stock market performing.
Yeah, for sure. Along with their lower GDP growth forecast, Goldman Sachs also lowered their year-end price target for the S&P 500. They're now targeting 6,200, which is down from their previous target of 6,500. So they're essentially saying that they don't think the stock market is going to do as well this year as they previously thought.
And they're attributing that to slower economic growth.
Yeah, they're basically saying that they expect weaker growth to translate into more muted returns in the stock market.
And it wasn't just Goldman Sachs who made these downward adjustments, right?
You're right.
The article mentioned some other firms as well.
Yeah, Yardeni Research also significantly reduced their S&P target. They dropped it all the way from 7,000 down to 6,400. And RBC Capital Markets also revised their expectations lower.
So it's not just one outlier.
No, it's definitely a trend. And this trend of multiple major research firms lowering their outlook for the S&P 500, it really underscores this more cautious sentiment that's starting to build around the market.
Yeah, it's like everyone's kind of getting a little bit spooked.
A little bit.
So with all this talk about a potential economic slowdown and, inflation sticking around and all these downward revisions from big investment firms,
Right.
what's the takeaway for, individual investors, like the people listening to this?
Yeah.
Should everyone be freaking out and, selling all their stocks right now?
Well, actually, the Motley Fool article specifically advises against making any hasty decisions like that. And I think that's really important advice to highlight. Even though the S&P 500 is currently about 8% below its all-time high, the historical trend has always been for the market to recover and eventually reach new peaks over the long term. Market corrections can definitely be unsettling and, a little bit scary in the moment. But they often present opportunities for long-term investors to buy high-quality companies at more attractive prices.
So it's kind of like that saying, buy low, sell high.
Yeah, exactly.
But it's hard to do in practice because everyone gets scared when things are going down.
Yeah, it's definitely easier said than done.
Yeah. So the key message is really about staying focused on the long term when it comes to investing.
Yeah, precisely. We're probably going to see some volatility in the near term as the economy slows down and interest rates potentially start to come down.
Mm-hmm.
But investors who are able to just stay the course and ride out those fluctuations are still very likely to see really good returns over the long haul. Trying to time the market perfectly, buying at the exact bottom and selling at the exact top, it's incredibly difficult to do consistently. And for most people, it's just not a realistic strategy. Often the best approach is to just stay invested and let those long-term trends work in your favor.
Yeah, it's kind of like that classic investing advice.
Yeah.
Time in the market beats timing the market.
Exactly.
All right, so let's just do a quick recap of the key points for everyone listening.
Sure.
The Fed is currently projecting slower economic growth. They're expecting inflation to be a little more persistent than they initially thought, and they're anticipating a potential increase in the unemployment rate in 2025.
Right.
This outlook is probably going to lead them to start cutting interest rates at some point this year.
Most likely.
And while lower rates can be a good thing for stocks over the long run, they can also be a sign of underlying economic weakness.
Uh-huh.
And that could lead to some short-term volatility in the market.
Exactly.
We're also seeing other economic indicators like declining consumer sentiment.
Right.
And some of those big financial firms like Goldman Sachs are revising their price targets for the S&P 500 downward.
Yep.
So all of that suggests that, the economic outlook maybe isn't as rosy as it was a few months ago.
Yeah, it's definitely a more cautious environment now.
And I think the main message from the Motley Fool is, don't freak out.
Don't panic.
Stay focused on your long-term investment goals.
Exactly.
And avoid making any rash decisions based on these, short-term market movements.
Sound advice.
So here's a final thought for you to consider. Given these projections of slower economic growth and potentially lower interest rates, how do you think different sectors of the economy might be affected?
Interesting question.
Some sectors might actually benefit from lower rates while others might struggle. Right. And then within those sectors, which specific companies or industries are best positioned to navigate this kind of environment?
Yeah, that's a really good point. It's important to remember that the overall market, like the S&P 500, it's made up of all these different pieces. And those pieces can react very differently to changes in the economic landscape.
Exactly. So it's not enough to just look at the big picture, you know?
Yeah.
You have to think about how those big picture trends are going to play out in those individual sectors and companies.
Yeah, and that's where the real opportunities and risks lie.
Exactly.
Yeah.
So that's something for everyone to think about as they're reviewing their own investment portfolios and, just thinking about the broader economy.
Absolutely.
So that wraps up our deep dive into the Motley Fool's analysis of the Fed's latest projections.
Witty discussion.
I hope this has helped to clear up some of the confusion.
I think so.
And give you a better understanding of what to watch for in the coming months.
Yeah.
Until next time, stay informed and stay ahead of the curve.
And keep on diving.
All right, we'll see you next time.